In the cockpit, a high reading on a gauge does not always mean good news. High oil and/or hydraulic temperatures. That's a warning, not a win. A high number is a signal. Your job is to understand what it's actually telling you. The same is true with dividend investing. This is Captain Pierce. Welcome back to Skies Capital for day 9 of a 30-day series. Think clearly, invest better. Let's go. A lot of investors see a big number and get excited. I get it. But there are really only two ways yield gets higher. One, the company raises its dividend, the business is strong. Two, the stock price dropped and the yield went up automatically. One of those is a good sign. The other is a warning light you should not ignore. Let me show you what both look like in the real world. Here's what matters so much for income investors specifically. When dividends gets cut, the stock usually drops at the same time. You lose the income and the value in one move, a double hit. The high yield often tells you that trouble is already coming. The market prices things in before the announcement. Investors need payouts that will hold up, not just in calm air, but through turbulence. Free cash flow is the only honest way to check if that dividend is real. Take UPS. Everybody knows UPS. The brown truck's been around forever. The yield right now is almost 7%. Looks great, right? But let's go under the cowling on this one and take a look. The yield is high because the stock price is down 40% from the peak. The dividend did not go up. The price went down. And when you look at the cash flow, UPS is generating $5.5 billion in free cash flow. But the dividend cost is $5.5 billion. That's basically a zero margin of safety. One rough quarter, one slowdown in trade, and the math changes. Now, UPS has a turnaround plan. It might work, but dividends backed by a plan is not the same as dividends backed by cash. Now let me show you the other side. AbbVie, ticker symbol ABBV. I own this one. The yield is around 3.2%. Not a flashy 7%, but look at what's behind it. AbbVie generated roughly $17 billion in free cash flow last year. The dividend cost is $10 billion. That's almost $2 of coverage for every dollar they pay out. Here's the part I really like. The biggest drug, Humana, lost its patent. The bear said the dividends was finished. Instead, AbbVie grew roughly 8.6%, set a record $61 billion. Their new drugs grew over 40%. They raised the dividend 5.5% just last year. That was the 13th year of increases. The payout is up over 330% since 2013. That is what real income looks like. Before you buy any dividend stock, run the checklist. First, what percentage of free cash flow is going out as dividends? Is it over 80% or 100%? You need a very good reason why. Second, does the free cash flow actually cover it? Not earnings, not EBITDA, free cash flow. Third, is the balance sheet getting better or worse? Raising debt to fund dividends is flying on borrowed time. Fourth, has the dividend been growing consistently? The track record tells you a lot about whether the management is the discipline and the cash to keep going. 4 items, 5 minutes, can save you years of regrets. Here is what I want you to take away from today. High yield is not income. Real income is yield you can count on. The number on the screens is just a gauge. Your job is to understand what it's actually measuring. Is it a strong business with real cash behind the payout, like Ambiv? Or is it a falling stock price making the yield look spectacular, like UPS is right now? Know what you are looking at before you call it income. This has been Captain Pierce with Skies Capital. Think clearly, invest better. For educational purposes only, not investment advice. See you on day 10.